So the US dollar is about to finish the week roughly 1% down after spending the last few sessions doing what it does best lately, reacting to headlines like their push notifications from a very chaotic group chat. And here's the real question. If geopolitics can swing markets this fast, what happens when the focus flips back to data and central banks next week? Let's answer that question. So before you place your next trade, watch this.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Good morning, I'm Francois, your market analyst here at ATFX Africa, and welcome to your daily market brief. During this session, you can expect the usual flow. We're going to kick things off with fundamentals, moving over to technicals, and adding in a couple of market one-liners, because if the market can change direction mid-sentence, we're allowed to smile once in a while. Starting the day with currencies. Now, the pound pushed up towards $1.35, its highest level in over 2 weeks, as US-Europe tensions appear to ease for now. The big driver on the US dollar side is the broader narrative. The dollar index held around 98.3 and was on track to end the week down about 1% after a volatile run driven by shifting Greenland headlines, tariff threats, then a reversal, then NATO, and yeah, it was just all over the show. However, now details remain still a little bit unclear on the framework around the US-NATO agreement, and markets are speculating the framework could involve mineral rights and even missile system installations, which tells you how far this story has traveled from trade policy into geopolitical speculation. On the UK side, we have a solid batch of data. The public sector budget deficit narrowed to £11.6 billion in December, which was below the expectations of £13 billion. Headline CPI rose to 3.4%. This is slightly above forecast. Service inflation ticked up to 4.5% from 4.4%. The unemployment rate stayed at 5.1%, and wage growth slowed to 4.5%, its weakest pace since April 2022. So the pound has reason to stay supportive. Easing external tensions plus a UK data mix that keeps inflation visible while growth and labor signals stay more cautious. So as we are looking at the cable today, we need to be answering the following question. If the dollar has already had a sell America wobble this week, does GBP USD continue climbing on US dollar weakness, or does it need a stronger UK growth pulse to keep momentum alive? Well, let's see if we can answer that question on the charts. So the technical structure here looks as follows. GBP USD has been pushing towards that 1.354 resistance zone. The 200 period exponential moving average sits around 1.34, and this price has been testing that area as a key line in the sand for short-term traction. The stochastics is around 50 on the daily time frame, relatively neutral, not exactly screaming trend day, more like let's see what the next catalyst brings. So the technical picture is basically as follows. A recovery that's trying to prove itself, but still operating in a zone where a clean break matters more than a hopeful bounce. Moving over to commodities, and this one is definitely a headline winner. Gold has pushed above 4,960 and set a new record, with prices around 4,967 at the moment. What's fueling it? Well, lingering geopolitical uncertainty. Even with the US stepping back from tariff and force rhetoric, a weak dollar backdrop overall for the week, and key macro context. US headline and core PCE rose as expected, pointing to disinflation continuing even as activity remains firm. Markets are now pricing in 2 Fed cuts later this year, while the Fed is still widely expected to hold rates next week. That combination matters for gold because the market is essentially saying we may not get cuts immediately, but we still think they're coming. There's also the major uncertainty wildcard. Investors are waiting for the US president's choice for the next Fed chair after he completed candidate interviews, with markets interpreting that as a more dovish appointment could lift expectations for additional cuts. And if that sounds like a lot of moving parts, well, it's because it is. Gold is basically trading like the market's insurance premium at this point in stage. It rises when the world feels uncertain, and this week gave it plenty to work with. Looking at the charts for today, technically the trend is strongly bullish, even if it's extremely overbought. On the 1 hour chart, the 21 EMA and the 100 EMA and the 200 EMA are all sloping higher. A classic uptrend structure. The 21 EMA is sitting around 4,910, which is a nearby dynamic support level. The 100 EMA is around 4,795, which reinforces the deeper trend floor. The stochastic readings are also elevated, around 85 on the 4 hour time frame and around 95 on the daily, which tells us momentum is stretched. But as we've seen repeatedly in strong trends, overbought can stay overbought longer than we expect. So the takeaway here is simple. Gold is moving like a market that still wants protection, even after some headlines have cooled. Finishing off today with equities, the FTSE 100 was also lifted by improved sentiment, rising more than 0.5% yesterday, recovering ground as the US president dropped the tariff threats linked to Greenland. The story here is risk mood improving. US president said he would refrain from imposing tariffs on European countries opposing his Greenland plan, a framework for a future deal, which was discussed with NATO, but no details were provided. So the market's response looks like relief, not resolution. On the UK side, supporting confidence, as stated, the public sector deficit narrowing was a positive surprise relative to expectations. In terms of shock movers for the session, however, ABF rose after backing full-year outlook, even with softer Primark like-for-like sales in Q1. E&M fell after cutting guidance again and flagging increased investments to turn business around. If we have a look at the charts, on the 4 hour time frame, the EMAs are still very bullish. Resistance is sitting around 10,250, with near-term support sitting at 10,060, followed by 9,920. On the daily time frame, the stochastics are around 80, showing the momentum is stretched. So the broader view is as follows. Risk sentiment is improving, and the FTSE participated, but it's doing so in an environment still driven by headline sensitivity and policy uncertainty. So as we head into this final trading session for the week and next week, the setup kind of looks as follows. This week was geopolitics and positioning. Next week, well, it's about whether the data narrative reclaims control. So watch the following very closely. First up, the Federal Reserve's meeting next week, which, as we stated, rate cut expectations should remain unchanged. However, any clarity or lack of it around the Greenland framework and what it exactly means could move markets. And the big suspense twist next week is, well, who gets named as the next Fed chair? Because the market is already debating how that could shift expectations. Because if the week taught us anything, it's this. The market doesn't just trade numbers anymore. It's trading narratives. And sometimes the narrative changes mid-candle. And with that, we wrap up your daily market brief. Brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX.com and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.